This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In terms of assets being made available by an employer to an employee for the employee's private use, we have seen that there are specific and indeed detailed rules by which we deal with certain individual assets. Living accommodation. When we saw living accommodation, specific rule. We looked at presuming it was purchased by the employer, the property in question. We took the annual value, and we then added in, if necessary, an expensive accommodation benefit. There's a specific set of rules dealing with the provision of living accommodation. We have more recently seen how to deal with car benefits and the provision of fuel. Again, a set of specific rules dealing with every car that might have been made available for the private use of an employee. And what we've also seen is a generic rule that applied to all other assets made available for private use that did not have their own specific rule. Where we saw that was back when looking at living accommodation, where furniture and furnishings might have been made available, of course, to an employee living in such a property. We also saw another separate example where maybe a TV was purchased for the private use of the employee. And that one, of course, subsequently then sold off at undervalue. Sold off, indeed, at least to the employee. Well, in addition to living accommodation, in addition to cars and fuel, which have their own specific rules, strangely, another vehicle, vans, and if necessary any heavier commercial vehicles, also have their own specific rules. Now those are the three that we need to know the specific rules for, and anything else, like the furniture and furnishings, like the TV set, anything else is dealt with under the generic rule of use 20% of the market value when first made available for private use. So what is this specific rule now that we have for vans and heavier commercial vehicles? You've got that company lorry, let alone company van to drive around in. Right, nowhere near as punitive, we might consider, as when we dealt with car benefits. But here, where an employee uses an employer's van for journeys between home and work, now that would normally, and certainly for a car, be classified as private use. Merely going from home to work is private. But here, if it's a van and it's for journeys between home and work, and any other private use is insignificant, that is not a word that you'll need to interpret here, you will be told, then there is no benefit. So if all you do is to use your company van for work, going to and from work and from one place of work to another, and then just a little bit of incidental private use, you maybe fill the back up of the van with rubbish to take to the rubbish tip every now and again, then you'll face no benefit whatsoever. And I would imagine that in real life, an awful lot of the provision of vans is covered by that exemption. But where the private use is not insignificant, then there is an assessable benefit. Nothing that we have to compute, only, I'm afraid, something that you have to remember, and that is a tax charge of £3,170 per annum. Again, per annum, it's another annual benefit, so yet again, if the company van has only been provided for 6 months in the tax year, then only 6/12 of that annual benefit would apply. In addition to the benefit in respect of the provision of the vehicle, we've also then got an additional charge made for fuel. Again, nothing to calculate, simply something to be learnt. And this is again only the case where we've got unrestricted private use. And there, 500, a strange number, £598 per annum would be the fuel benefit. Again, per annum, each of these therefore are time apportioned, if only provided for part of the tax year. So living accommodation, cars along with the fuel, and vans along with their fuel have their own specific rules of how to determine any assessable benefit that may apply. Any other assets made available for private use, as we said, the generic rule, take again as an annual benefit 20% of the market value when first made available for private use. Thankfully, so far as the benefits are concerned, there's just one more benefit that we need to deal with. And this time, we talk about beneficial loans. Yeah, if the employer is generous enough as to lend money to an employee for whatever agreed purpose that may be, and the loan is made at a beneficial rate of interest. Now, that beneficial loan is where the interest rate charged, if any, quite often we have interest-free loans in terms of exam questions, but the interest rate, if charged, is less than the official rate of interest. So as we say here in note 1, a beneficial loan is one made to an employee below the official rate of interest, and you may remember that to be 3% from when we were looking at our expensive accommodation benefits, and again there we use that official rate of interest. Again, it will be provided to you on your rates and allowances pages there. So, having determined that a beneficial loan has been provided for at least some point through the tax year, how do we compute the benefit? The benefit is the interest on the loan at the official rate, 3%, less, of course, any interest, if there is any, actually paid by the employee. But again, we have an exemption level, and that is there will be no benefit if the loans do not exceed £10,000 in total at any time in the tax year. So as long as we've never gone above 10,000 at any time in the tax year, there'll actually be no calculations to do. Now, of course, in any exam question, that's not very likely, is it? If we're going to earn 2 marks in an objective testing question, there's going to be something to calculate. So again, at some point in the tax year, any loan is likely to be in excess of £10,000. What we now see is that rather than just having one method, there are 2 methods indeed by which we may determine what will be the assessable benefit. The one normally used, the sort of default setting, is the average method. But there's then an accurate method, sometimes known as the strict or actual method, which is to be used if either the taxpayer elects to have the strict or accurate method applied instead of the average method, or if HMRC choose to take it. So either the taxpayer or HMRC may choose to take this. Now, of course, what would happen? If, of course, the accurate method gave a lower assessment, then it is the employee who would say to HMRC, I'm electing to have the accurate method used here, please. If, of course, you had a situation where you had a higher assessment being derived, then it would be HMRC who would have the right to exercise that option. Quite often in real life, if there's very little difference, if the accurate method is only slightly higher there than the average, then HMRC won't bother. Normally, as I say, it is the average method that is used, because if an employer provides a beneficial loan to an employee, they will presumably have organised the way in which that loan will be repaid. And more often than not, that is by salary deduction each month of the year, taking something, a capital repayment of loan, out of their salary on a monthly basis. Well, you're going to use the average method. You don't yet know what it is, but all it very simply is to look at if there have been repayments of the loan during the tax year. All we do is take the loan at the start of the year, plus the loan at the end of the year, divide by 2, and that's the average loan outstanding for the year. The strict method would be to look at exactly how many months was the loan one figure, another figure, another figure, and strictly compute the amount of benefit on that basis. If it's being repaid every month, you're not going to do 12 individual calculations on a monthly basis. You would just use the average method. that strict method, that accurate method, is there primarily to protect HMRC from situations where, if you had a loan outstanding at the beginning of the year of, say, £40,000, but then on the 4th of April, there having been no repayments at all during the year, the employee repaid the £40,000, then at the next day, the end of the tax year, the 5th of April, the outstanding loan would be zero. So in which case, therefore, on the average method, opening loan 40,000 plus closing loan 0, divide by 2, 20,000, you'd base the assessable benefit on that. What the employee could then do, with, of course, the permission and collusion of the employer, no doubt, on the 6th of April, take the £40,000 loan back out again. Now, HMRC are not going to stand for that little game to be played. So if you tried that as an employee with the employer's blessing, all they do at HMRC is say, no, it's not 20,000 at 3% that we'll use. What we will do, and in real life it's done to the nearest day, in terms of us in exams, we time a portion to the nearest month. But what HMRC would do is say, okay, for 364 of the 365 days in the year, the loan outstanding was £40,000. And for one day, it was 0. And we'll do the benefit on that basis. So having that accurate method stops that happening. It also protects the taxpayer, that if, for example, one-off capital repayments are made and the employee makes a capital repayment or repayments in the first half of the tax year, meaning that more than half of the tax year the loan outstanding was lower than the average figure would come out to because of those repayments in the first half of the year, it allows the employee to have a lower assessment as a result of that. So it's a sensible rule to have, only usually exercised by HMRC where there are clearly large repayments happening towards the end of the tax year, exercised by the employee if repayments, substantive repayments, have been made in the first half of the tax year, and it will never be used. The average method would be used if we simply got a monthly deduction from salary. Okay, that's what they are. We've got the notes here to back that up. The average method, loan outstanding at the beginning and the end of the tax year. We take an average of that. Opening loan plus closing loan, divide by 2. If the loan is taken out or paid back during the tax year, that date is used instead of the beginning or end of the tax year. We look at, for example, if you had a £40,000 loan outstanding at the beginning of the tax year, and we then had the situation where it was repaid halfway through the tax year, then what we would do in terms of our average basis, the loan taken out or paid back during the year, that date is used instead of the beginning or end of the tax year. So it was £40,000 at the beginning of the tax year, it was £40,000 when the loan was repaid, and we calculate our benefit based on that £40,000 loan, but it's for 6 months. Clearly it was not outstanding for the full year. What you don't do there is to say, well, the loan outstanding at the beginning of the year was 40,000. At the end of the year, oh, it had been repaid, so it was 0. Do an average loan, calculate that annual benefit, and then times it by 6 months. No, it doesn't work that way. What do you have at the start? What was it when it was repaid? £40,000. Work out the benefit on that, and then time the portion, because you didn't have the benefit for the entirety of the tax year. Accurate method, again, as we said, day by day in real life. We will do it to the nearest month, where we look at what was or what were the amounts of loan outstanding through however many months of the tax year, and then multiply those actual loans outstanding by 3% and compare it with any loan interest paid to the employer during the period. Now, we've got a little example here to illustrate this, example 6, where we've got a couple of repayments being made. We've got to calculate now the taxable benefit, obviously for our tax year 16-17, using firstly the average method and then applying the accurate method. Again, as you'll be told on your rates and allowances page, but a reminder here, official rate of interest is 3%. Okay, what we first of all want to know is whether the loan was outstanding at the beginning of the tax year or whether it has been taken out partway through the tax year. Well, here we're told loan of $35,000 given by the employer on the 31st of March 16. So at the start of the tax year, a few days later, the 6th of April 16, there was a £35,000 loan outstanding. So using firstly our average method, we know that the loan outstanding at the start of the year was $35,000. All we now need to do is to work out what was the loan outstanding at the end of the year. Well, we're told that interest is payable on the loan at 1% per annum. And on the 1st of June 16, Jack repaid $5,000, and on the 1st of December 16, a further $15,000. The remaining $15,000 was still outstanding on the 5th of April 17 there. So the loan outstanding at the end of the tax year was $15,000. So opening loan plus closing loan, divide by 2. That 35 plus 15 is what? 50, divide by 2. That therefore will be 25,000. What is the official rate of interest times 3%? And that would give you £750. Now, this was an interest-free loan, and as I say, thankfully and happily, often in exam questions they are. If it was interest-free, that's it. £750 is the assessable benefit for the 16-17 tax year. But where interest is being paid and capital repayments have been made during the year, then we've got to work out exactly what the interest paid would be. So our interest paid there. Now, this calculation of interest paid is actually going to kill two birds with one stone, as the old proverb goes. We need to deduct it here, of course, in working out the overall assessable benefit using the average method. But of course, it's a figure that we'd need to know anyway to be able to work out the assessable benefit using the accurate method. So it's a figure that we'll use in both calculations. Now, this is where you've got to look at the timings. Now, we know the start of the tax year, 6th of April 16. And when was the first repayment? On the 1st of June 16. So from the 6th of April to the 31st of May 16, the loan outstanding was £35,000. That, as we know, we have an interest payment on that of 1%. It was the fact that it was 1 less than 3 that made it a beneficial loan in the first place. So 35,000 at 1%, that would be an annual figure. How many months is that? April and May, it's 2 months. So take 2/12 of that figure. We've then got, the 1st of June 16 to, when was the next repayment? The 1st of December, where a further 15,000 was repaid. So from the 1st of June here, that's the first, let's write that in again, shall we? Pen here. 1st of June 16 to the 30th of November 16, we had repaid £5,000. So for that period, it was a £30,000 loan, outstanding still, at 1% times, well, how many months is that? We've got June, July, August, September, October, November. So we've got therefore some 6 months. So times 6/12 will equal. Finally, 1st of December 16, there were no further repayments through till the 5th of April 17. The repayment on the 1st of December 16 was 15,000. That brings the loan outstanding, as we know, down to 15,000, which is what the figure was at the end of the tax year. We were paying 1%, and that was for the remaining months. Well, we've already done 2/12 and 6/12, so that's 8, so it must be 4, but just check. We've got December, January, February, March. Yeah, that is 4/12, and we'd work those figures. So having established, therefore, what the overall interest payments would be, that figure would then be deducted in giving you your assessable benefit using here the average method. Now, if you do all of those calculations, you can put those figures through your calculator and check, but I made that a total deduction there of £258. Now, again, do check through that you've got that figure, but simply whatever it is deducted then from the £750, and if it is 258, I made that £492, therefore, as the assessable benefit using the average method. The strict method, looking at that one now, strict or accurate, oops, start again, B, the second one, the accurate method. Now, we already know that the actual interest paid is 258. Using the accurate method, we've got to work out the beneficial loan for exactly the same periods as we see there, 6th of April 16 through to 31st of May 16. So it's exactly the same, those 3 periods. It's exactly the same amounts, 35,000, 30,000, and then 15,000, and the only difference is that the official rate of interest is 3% that we work it on, but of course we still do the same time apportionments, times 2/12, times 6/12, times 4/12. There we go. And we take away from that, of course, the amount of interest actually paid. So you work using that strict or accurate method. How many months of loan were there where the outstanding sum was 35,000? How many months at 30,000? How many months at 15,000? For those months at the official rate of interest of 3%. And as I said, for those months, we do the time apportionment accordingly. Now again, if you work those figures through, I worked that this little amount here would come to a total of 775. So we're talking there about being £25 more than the average method, which gave you 750. You'd still be deducting 258, and on that basis, therefore, you take that away, and that would leave you with 517. So it means that the accurate method is higher. So it means that HMRC would be entitled, if they wanted to opt for the accurate basis, as that would, of course, give a higher assessment there. Had the accurate method given a lower figure, it's probably very likely that, of course, that the individual, the taxpayer, would then make the election to go for the accurate method. Okay. Now that should allow us, therefore, to work out all of the potential assessable benefits. Very important chapter. Again, something will always be tested, whatever section it may come up in, and for however many marks. But there's always going to be something to do with employment income, and that tends to, again, in the most part, be about assessable and or exempt benefits, and occasionally allowable deductions like your authorised mileage allowance payments, for example. So you need to focus on this particular chapter. You might get the lion's share of the marks on a Section C, 15-mark income tax computation even, being given over to a range of benefits being provided to the employee that you need to construct, put together, and put it in with all the other amounts of taxable income for the taxpayer to their income tax computation, and as we were then doing in Chapter 2, computing the income tax liability or even income tax payable for our 16-17 tax year as a result. Now, so far as this chapter is concerned, all that remains here is the administrative part dealing with the pay-as-you-earn system. Now, we've mentioned this before back in chapter 2, and all it is a very sensible system on the part of HMRC, whereby they get the employers to deduct income tax at source, as we'll see soon, also to deduct employees' national insurance contributions at source, and then the employer, having collected all of those amounts up from the various employees by deduction at source, you don't get your gross salary, you only pick up your net salary each month. Those payments would then be made over by the employer to HMRC. So HMRC are getting the employers to do their dirty work for them and collect at source. Now, again, you can have a little read through here, the employer's duties, what they have to do, and how PAYE is applied. But at the very end of our course, once we've dealt with all the doing things, we will come back and deal with the administration part in brief, but we'll deal briefly with that administration part of the syllabus. That will involve here PAYE. It will also involve our income tax administration chapter, self-assessment for individuals, and also the corporate tax self-assessment chapter as well, and deal with all of that admin, where at least I will pick out for you the main issues that we need to be aware of. So that awaits us at the end of the course. I really wouldn't be bothering with it now if you are now still several weeks or months prior to taking your exam. You need to focus on all of the doing things. We've done that in the chapters to date so far as income tax is concerned. We've got one more chapter of doing things where, having mentioned back in chapter 2 about pension contributions, chapter 10, next chapter, looks at those pension contributions. We remind ourselves of what we already know about them, and we also go on and see the new issues that we need to be aware of in relation to them as well. Further on to chapter 11, we've got a nice short little chapter, complete tax, it's national insurance contributions there. That will sort out that one. And then we get into the other main personal tax, at least while a taxpayer is alive anyway, capital gains tax. After that, then there's this administration chapter that I referred to. That, again, you will leave alone. I'll remind you at the time just to leave it alone. And then you move to corporation tax. Again, we'll then ignore the admin chapter at the end of that before going to VAT, IHT, consider tax planning. Once all that has been done, then we'll come back and we'll have a look at those admin issues and pick out the most salient points. But no good early in your studies trying to memorize those administration points. It's not going to serve you any good. You need to get to grips with the doing things, how it is each of the various tax computations are prepared, the rules by which income is assessed, capital gains are assessed, companies are charged a corporate tax. How do we deal with an account for VAT? How do we compute IHT, whether that be most usually on death or in lifetime? These are all the big issues. These are the things that if you can do them, you'll pass the exam. If you can't do them, you won't pass the exam. The admin, yes, there will be questions, probably objective testing questions in there, but that's rather more the icing on the cake and requires a retention capacity, a memory factor coming in there, and that's probably better done closer to exam date once you become comfortable and practiced all of those doing things. Okay, that therefore finishes off chapter 9, at least for the moment. And in our next chapter, as I say, we'll complete our studies of the doing things of income tax by looking at pension contributions. Again, as ever, I look forward to talking to you again next.